QuickBooks Pro Desktop 2021, adjusting entry, forward contract. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our practice problem 4 practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. In prior presentations, we made a purchase of property, plant, and equipment on account, meaning we have a payable that we're going to pay in the future. We're going to be paying it in foreign currency. In order to mitigate the risk of that foreign currency payment, we also set up a forward contract that we put on the books. We then did an adjusting entry for the accounts payable. Now we're going to do an adjusting entry for the forward contract. Let's take a look at it. Go into the reports dropdown, company and financial, scroll it on down to the balance sheet standard. We're going to customize the dates up top from 01/01/21 to 12/31/21. Go ahead and run that report. So we put on the books the purchase of the equipment using the current spot rate at the point in time we put it on the books. The other side then went to the accounts payable, which we're going to be paying in the foreign currency. Then we made an adjusting entry so it was correct using the spot rate at the end of the year, so our financial statements would be correct at that point in time. Then we also had a forward contract we put on the books to mitigate the risk of the fact that we're going to be paying this one in foreign currency. That resulted in this receivable up top that we have on the books. That's the one that we're going to be changing at this point in time to adjust it to the current value, which will be a little bit different because we're going to have to use the forward rates as opposed to the spot rates. Let's first take a look at it in Excel. So we're in Excel. We're focusing in on, I'm going to put the little yellow dot or square, a rectangle. It's a rectangle because the sides aren't all the same size. So I'm going to go down here and say we're focusing in on this one. That's the one that is going to be changing. So we're going to change that. That's the forward contract that we're going to be dealing with. Now it's the end of the year, so we've got to deal with the changing of the rate. Let's pull out the trusty calculator to do that. Here's the trusty calculator. So similar calculation last time, but we got to use the proper rate, this time being the forward rate as of 12/31/X1. So we have the same 100,000 in foreign currency units we will be receiving, times now, however, not the spot rate, but rather the forward rate, which is 0.612. So then if we compare that to what is currently on the books, we have the 60,900 on the books. So we're going to have to increase it by minus, I'm going to say minus the 60900. That's going to give us a $300 increase. So we're going to increase the receivable, which would be good because that means, you know, the asset is going up. Let's kind of evaluate that real quick. We're going to say, well, last time, then one foreign currency unit, Australian dollar, could be purchasing using the forward rate, speculating out into the future, 0.609. Now one foreign currency unit can purchase more parts of a dollar, 0.612. That means the foreign currency unit got stronger, and we're talking now about a receivable. Therefore, we're going to be receiving in foreign currency units that have strengthened since the point in time we started the foreign contract. That would be good for us. That would be a benefit. So we're going to have a gain here. Note that the gain is hedging out, or we shouldn't use the hedge. It's mitigating the risk, mitigating the risk that we have for the loss that happened basically up top. So we have the loss up top, and now we're going to have the gain. It doesn't cancel each other out exactly due to the fact that for this item, we have to use the spot rate, or we get to use the spot rate, I guess, whichever. And for this one, we have to use the forward rate, the speculative rate. But it should still have a similar effect to kind of cancel each other out and mitigate some of the risk that we would have for this accounts payable being on the books, resulting in something like this loss that happened here. So we're going to say, all right, then that's going to be the receivable. We'll pick up the receivable up top. So the receivable, the other side is going to go to the gain on down below. Let's do the calculation once again in the cell here. We're going to do it this way this time. Equals brackets. I'm going to take the larger of the two numbers or the rates we're going to be using, which is the 0.612 minus the 0.609, close the brackets, multiply times the 100,000 units of Australian dollars. There's the $300 item once again calculated another way. So now we're going to record this out. So we're going to go to the receivable up top, double clicking on it because something's in it, plus, and then we'll pick up that $300. And that brings it up to that 61,200. Let's just double check that one more time. So if we pull out the trusty calculator, that was the 100,000 times the 0.612, which is the forward rate, 61,200. And that's what we had here. So 61,200 is correct, is correct. And then the other side is going to go down to the gain. We broke out the gain in a separate account instead of kind of netting the gains and losses out in one account. So you could see them kind of broken out down here. We'll net them together in QuickBooks. So there we have it. So we had a $100,000 loss, and we mitigated it to some degree at least, lowering it down with this forward contract. All right, let's do it now in QuickBooks. So when we do it in QuickBooks, we're going to have to set up a similar kind of adjusting entry, but we got to be careful that we're picking up the correct rates to do so. So let's go back on over to QuickBooks, and we can go to the lists drop down here, and I want to go to the foreign currency list. Now, in the foreign currency list, now we could download, if we were doing this in the current time period, by going to the activities and download the latest exchange rates. And we can get the latest exchange rates, but those are the spot rates. If I double click on this, imagining that we had already done so, that would be the 0.61 rate. And we need the forward rate here. So I'm not going to enter this again, another item for the forward rate, but rather I'm just going to enter it when we do the transaction. So I'm going to close out of there. I'm going to see if I can do the same kind of adjusting entries. So the same kind of adjustment here, but I'm going to have to manually put in the forward rate instead of the spot rate. So I'm going to say activities rise up, and we want to say I want to do a home currency adjustment. Home currency adjustment, please, QuickBooks, as of 12/31/21 for the Australian dollar. And then it picks up this rate because that's the rate we have in there, but that's the spot rate. Wrong rate for us. We're going to manually put in the forward rate, which is 0.612. So this one's close, but it has a 2 with it as well. So that's going to be the forward rate. So I'm going to say calculate using that forward rate. And so there we have it. And so we are now looking at the item for the vendor, for the customer this time. So we want to look at this one up top, the customer item. Notice it recalculated the vendor item too, but I don't want to pick that up because it was correct using the other rate last time. So we're picking this one up, and this is going to be the 100,000 receivable we had on the books. That's going to be in Australian dollars. It was on the books for the 60,900, given the prior rate that we used, which was the forward rate at the point in time we put it on the books. Now we're at the 61,200 using the current rate, the 0.612, which is a difference and adjustment that will be recorded by the system of $300. Let's go ahead and save it, close it, then check it out. Saving it, closing it, Xing out, checking it out on the balance sheet. So here is the balance sheet. If we go to the receivable then, double clicking on the receivable, we see that it started out at that 60,900. We now have the 300, bringing it up to the 61,200, which I believe matches the item where we had that yellow rectangle next to it, because that's the one we're looking at. 61,200 looks good. So that's correct. If I double click on this $300, then we will see the journal entry. So it just made a journal entry when we do that little adjustment. Debits and credits, closing this back out. Other side, closing this back out, will be on the income statement. Going to the reports drop down, going to the company financial, take a look at the P&L, profit and loss, otherwise known as the income statement. Changing the dates up top from 01/01/21, 12/31/21. And so now we have the 700. Notice it nets them out here. So if I go to the Excel, we put them in two separate accounts, 1,300, 700 net. Net here, 700. Double clicking on that, we see that we have the 1,000 from the prior transaction, the 3,000 here, which of course nets out to that $700 amount. So that's what we have here. Now, if I go back to the home page, note that the fact that we put these adjusting entries kind of in the middle of the process for the bill and the receive means that it's going to kind of muddy up our typical process, because QuickBooks would have, for both the receivable and payable that are in the foreign currency units, adjusted for the gain or loss when we enter the bill and the receive payment. So but we couldn't just leave it out, because then it would calculate the full difference and it would put it into the wrong time period. So for us to put the correct amount of gain or loss in the first year and the second year, we needed the adjusting entry. We're going to need a reversing entry to make it all play out, and we'll see how that will play out in future presentations.